Right now, something is happening in the global macroeconomic system that almost nobody is explaining correctly. Stay with me, because what you are witnessing is not a standard market correction, but a structural wealth transfer of unprecedented magnitude that will define the financial hierarchy for the next century. Mainstream financial channels are entirely misinterpreting the current volatility, attributing the chaos to superficial daily headlines rather than the underlying mechanical forces that are actually driving the global economy into a new paradigm. Over my 4 decades of experience analyzing historical market cycles, sovereign debt crises, and the rise and fall of reserve currencies, I have learned that when the consensus narrative becomes this desperate and completely disconnected from fundamental reality, a massive inflection point is imminent. We are currently watching the last big wealth opportunity before you retire unfold in real time, driven by predictable sequences of human behavior, institutional mechanics, and the inescapable mathematics of the long-term debt cycle. You see, the current market panic is not a reflection of true fundamental deterioration across the board, but rather a mechanical liquidity crisis where highly leveraged portfolios are being systematically liquidated, creating artificial price drops in critical assets that possess immense intrinsic value. This creates a rare structural divergence between price and value, a phenomenon that occurs perhaps once in a generation when the old economic order transitions into the new. When massive financial institutions and hedge funds face severe margin calls across their broader portfolios due to rising interest rates and tightening liquidity, they do not sell what they want to sell. They are forced to sell what they can sell, which inevitably includes their most pristine, highly liquid, and fundamentally sound assets. This dynamic creates a temporary illusion of weakness in sectors that are actually fundamentally robust, trapping retail investors in a psychological cycle of fear and capitulation, while institutional insiders quietly accumulate these deeply discounted assets. To understand how to position yourself, you must stop looking at the market through the lens of daily price action and start looking at it through the lens of systemic plumbing and forced behavioral mechanics. We are at the end of a 70-year debt supercycle, a period where fiat currency debasement has reached a mathematical endpoint, forcing a global repricing of all tangible and productive assets. In this environment, the greatest danger is not market volatility, but rather the failure to understand the mechanisms of wealth preservation and transfer that are currently operating beneath the surface. I'm going to walk you through 3 specific, highly asymmetric windows of opportunity where this exact dynamic of forced selling has created massive dislocations between temporary price and long-term value, allowing you to capture generational wealth if you simply understand the arithmetic of the trade. The first critical area to examine is the precious metals sector, specifically the gold and silver markets. We are currently witnessing an environment where inflation is structurally entrenched, geopolitical tensions are escalating to levels not seen since the Cold War, and the global monetary system is undergoing a profound transformation away from a unipolar fiat standard, yet precious metals have frequently experienced periods of baffling weakness that confuse the average investor. This is where you must separate emotion from mechanics. The recent drops in gold and silver prices during periods of broader market stress are not a repudiation of their historical role as the ultimate store of value, but rather the direct mathematical result of forced selling in the paper derivative markets. During periods of severe market stress, highly leveraged funds face massive margin calls, forcing them to raise cash immediately to satisfy their clearinghouses. Because gold is one of the most liquid assets on the entire planet, trading billions of dollars a day in highly efficient markets, it is often the very first asset to be liquidated to cover these immediate cash obligations. This indiscriminate selling of paper contracts creates a temporary dislocation, driving the spot price down, even as the fundamental macroeconomic value of the physical metal continues to rise exponentially. But while the emotional crowd panics and sells their holdings into the weakness, assuming the asset is broken, the smart money recognizes this as a purely mechanical inefficiency. Central banks around the world, particularly in the East, acting as the ultimate inelastic buyers, are currently acquiring physical gold at a record, unprecedented pace, quietly removing thousands of tons of supply from the physical market while paper contracts are dumped by distressed hedge funds in the West. This massive accumulation by sovereign entities is a clear, undeniable signal that the underlying value of the asset is recognized by the very institutions that control the global money supply and understand the long-term structural shifts occurring in the global monetary order. They know that the current system of unbacked fiat debt is mathematically unsustainable, and they are using the temporary price suppression caused by Western margin calls to aggressively acquire the only financial asset that carries no counterparty risk. When this wave of forced liquidation is finally exhausted and the paper derivative market loses its ability to dictate the price of the physical commodity, the artificial downward pressure on price will violently evaporate. The market will be forced to reprice to reflect the true underlying supply and demand dynamics of a world that is rapidly losing faith in fiat currency, resulting in a massive upward revaluation for those who had the foresight to acquire these assets when they were artificially depressed by the mechanical selling of leveraged speculators. But first, if you find this kind of system-level analysis valuable, subscribe now. Subscribe now. Moving beyond the monetary metals, the second major window of opportunity lies in the global energy sector, specifically in the deeply misunderstood and heavily penalized coal industry, where a profound structural imbalance has been created by the intersection of ideological mandates and unyielding physical reality. For the past decade, the global financial system has been gripped by a massive wave of ESG divestment, with trillions of dollars systematically starved from traditional carbon-based energy infrastructure by institutional asset managers, pension funds, and major commercial banks. This massive coordinated withdrawal of capital has resulted in a severe, decade-long lack of investment in new mining supply, infrastructure, and exploration, creating a structural supply deficit that cannot be easily or quickly rectified, regardless of how high prices eventually go. At the exact same time, the global economy, particularly in rapidly industrializing emerging markets, continues to demand ever-increasing amounts of reliable baseload power to function and grow, a reality that became acutely and painfully apparent during the recent global energy crisis. When you have a macroeconomic situation where demand is structurally inelastic because human civilization literally depends on it to survive, but supply has been artificially and aggressively constrained by ideological capital allocation and political pressure, you create the ultimate powder keg for explosive, sustained price appreciation. The mainstream narrative, driven by hopeful political rhetoric rather than thermodynamic reality, suggests that coal is a dying industry, a stranded asset entirely destined for immediate irrelevance as the world seamlessly transitions to wind and solar power. However, the cold, mechanical reality is that emerging markets, which represent the vast majority of future global economic growth and demographic expansion, are entirely dependent on coal to power their industrialization, build their cities, and lift their populations out of poverty. Furthermore, as the global energy crisis intensifies and the severe physical limitations and grid instabilities of intermittent renewable energy sources become mathematically undeniable, even developed Western nations are being forced to quietly return to traditional baseload power simply to keep their electrical grids from collapsing during periods of peak demand or adverse weather conditions. This realization is triggering a massive, albeit silent, reversal in global capital flows as pragmatic institutions realize that the ESG-driven starvation of the sector has created an unsustainable and highly dangerous imbalance in the global energy architecture. The companies that produce this absolutely essential commodity are currently trading at deeply distressed valuations, often priced for imminent bankruptcy. Yet they are generating massive, unprecedented amounts of free cash flow while being completely ignored by the broader market. They are paying out massive dividends, buying back their own stock at record paces, and fortifying their balance sheets, all while the retail public refuses to touch them due to lingering stigma. When the undeniable reality of the global energy architecture finally forces a broad market repricing of these critical assets, and the institutional capital is forced to return to the sector simply to capture the yield, the resulting wealth transfer will be absolutely staggering. This will disproportionately reward those contrarian investors who understood the underlying mechanics of ESG divestment, the temporary nature of political narratives, and the inescapable, unforgiving laws of thermodynamics that dictate human energy consumption. The third structural window of opportunity is currently unfolding in the biotechnology sector, driven by a highly predictable sequence of corporate mechanics, regulatory timelines, and absolute demographic inevitability. We are currently rapidly approaching a massive, unprecedented patent cliff in the global pharmaceutical industry, a structural event where some of the world's largest, most profitable, and most well-capitalized companies will simultaneously lose their exclusive patent protection on their most lucrative blockbuster drugs over the next 3 to 5 years. This catastrophic loss of exclusivity will immediately expose these pharmaceutical giants to fierce margin-crushing biosimilar competition, threatening to completely decimate their core revenue streams, erode their historical market dominance, and collapse their stock prices. Faced with this absolute existential threat to their survival, these massive companies have only one viable, mathematically sound survival mechanism available to them. They must aggressively acquire smaller, highly innovative biotechnology firms to immediately replenish their depleted drug pipelines and secure their future revenue growth. They cannot simply invent their way out of this crisis internally because the research and development cycle takes too long and the patent cliff is approaching too quickly. This desperate structural need for immediate innovation coincides perfectly with a period of severe historic market dislocation, where the broader biotechnology equity index has been completely crushed by rising macroeconomic interest rates and a broader indiscriminate flight from all risk assets. Hundreds of small and mid-cap biotech companies possessing incredibly valuable patent-protected intellectual property and highly promising late-stage clinical assets are currently trading at valuations that are a mere fraction of their true fundamental worth, with many literally trading below the actual cash they hold on their balance sheets. This creates a profound, almost unbelievable structural asymmetry in the market. The large pharmaceutical companies are currently sitting on hundreds of billions of dollars in accumulated cash reserves, acting as well-capitalized, highly motivated, and entirely inelastic buyers who are driven not by casual expansion, but by the absolute biological necessity to acquire growth at any cost to survive the impending patent cliff. When this inevitable wave of forced M&A activity begins in earnest, these massive acquirers will be mathematically forced to pay massive triple-digit premiums to secure the specific clinical assets they desperately need. The emotional retail crowd looks at the recent downward price action in the biotechnology sector and sees only danger, risk, and chaos, completely missing the underlying structural corporate mechanics that guarantee a wave of massive, high-premium acquisitions. By understanding the rigid timeline of the patent cliff, the regulatory framework of drug approval, and the inevitable corporate desperation it creates in the boardrooms of big pharma, you can strategically position yourself exactly ahead of this massive capital rotation, capturing the immense value that will be unlocked when these deeply discounted, severely misunderstood assets are acquired at premium multiples. Let me bring these three distinct windows of opportunity together into a cohesive macroeconomic framework because they are all ultimately manifestations of the exact same underlying systemic phenomenon. the temporary, highly exploitable dislocation between market price and fundamental value, driven entirely by structural mechanical forces rather than actual economic reality. Whether it is the forced liquidation of physical gold due to leveraged margin calls in the paper derivative markets, the artificial starvation of capital in the critical coal sector due to ideological ESG mandates, or the indiscriminate rate-driven selling of biotechnology assets immediately ahead of a massive industry-wide patent cliff, the psychological and mechanical mechanism remains exactly identical. We are currently witnessing a massive systemic repricing of global risk, where the emotional, reactionary crowd is making purely arithmetic decisions based on fear, margin constraints, and short-term volatility, while highly sophisticated institutional insiders and sovereign entities are capitalizing on these exact mechanical inefficiencies to acquire the world's most pristine assets at historic generational discounts. To truly understand the sheer magnitude of this opportunity and the danger of ignoring it, you must look at the historical macroeconomic parallels, specifically analyzing the economic environment of 1979. During that precise historical period, the global economy was gripped by a remarkably similar convergence of deeply entrenched structural inflation, severe geopolitical instability, energy crises, and a profound systemic crisis of confidence in the prevailing fiat monetary order. The broader equity markets had been seemingly trapped in a brutal decade-long cycle of stagnation and painful decline, leading many prominent financial commentators to erroneously conclude that the era of American wealth creation was permanently over. However, entirely beneath the surface of this apparent macroeconomic chaos and widespread public despair, a massive structural shift in capital allocation was occurring. Those rare contrarian investors who deeply understood the underlying mechanics of inflation, the reality of global energy dependency, and the inevitable mathematical repricing of tangible assets, were able to strategically position themselves for what would become one of the greatest, most explosive wealth creation cycles in modern financial history. The current macroeconomic environment is a direct, undeniable mirror of that exact historic inflection point, amplified by significantly higher levels of global debt and more extreme monetary policy distortions. We are standing at the absolute precipice of a massive structural realignment in the global financial system, where the artificial distortions created by decades of dangerously easy monetary policy, 0% interest rates, and ideological capital allocation are finally violently colliding with the unforgiving realities of physical commodity supply, unstoppable demographic destiny, and the absolute mathematical certainties of the long-term debt cycle. This is emphatically not a time for blind panic, emotional decision-making, or hiding and depreciating cash. It is a time for calculated, ruthless objectivity and decisive action. The extreme volatility and apparent chaos you see in the financial markets today is the exact necessary mechanism through which ultimate wealth is permanently transferred from the reactive emotional majority who do not understand the system to the prepared analytical minority who do. The data points are abundantly clear. The structural macroeconomic forces are already in motion, and the hidden mechanisms of forced selling and inevitable institutional demand are already executing their predictable, unstoppable sequences behind the scenes. Ultimately, as we navigate this historic transition, there are only two types of investors in the world right now: those who are completely paralyzed by the daily media noise, allowing their hard-earned wealth to be slowly and silently eroded by persistent structural inflation, and their portfolios to be liquidated at the exact wrong moment due to fear, and those who clearly recognize the structural reality of this new macro environment, actively utilizing this temporary period of forced selling and market dislocation to aggressively acquire the specific, fundamentally robust assets that will inevitably dominate and define the next economic cycle. The window of opportunity to capitalize on this massive, unprecedented wealth transfer will not remain open indefinitely. As the mechanical forces of forced liquidation finally exhaust themselves and the weak hands are completely shaken out of the market, the massive pools of institutional capital sitting on the sidelines will aggressively step in to reprice these critical assets, violently closing the gap between current price and true value, and leaving the emotional retail crowd behind once again to buy at the top. The ultimate responsibility to act, to rigorously separate the mechanical truth of the market from the superficial noise of the headlines, and to strategically position yourself for this historic systemic wealth transfer rests entirely upon your own shoulders. You must decide right now whether you will be a passive victim of this structural macroeconomic realignment, watching your purchasing power evaporate, or a proactive beneficiary of its inevitable, mathematically certain conclusion, because the greatest, most asymmetric wealth opportunity of your entire lifetime is happening right now, hiding in plain sight directly behind the veil of temporary market chaos.